Our job begins where most advisors stop. Saving money is great, but how do you spend it without risk in retirement? Welcome to Every Day is Saturday with Brad Gatto and Matt Stahl, partners and private wealth managers at Fiat Wealth Management. In this podcast, we aim to broaden your knowledge about the financial world we live in today and make the boring and complex financial decisions fun, informative, and educational. Join us on this journey where Brad and Matt will explore different strategies on how to spend your money without guilt and have peace of mind knowing you are spending it the optimal way in retirement.
Hello, everybody. Welcome back to Every Day is Saturday. I'm Matt Stahl, along with my partner, Brad Gatto, and we are joining you for a special edition today.
Sure, that's what you want to call it.
This is something we don't normally talk about. So we don't like to bring attention to any financial market, necessarily the daily movements that you see throughout a period of weeks or months necessarily. But we're at a point here where we do think it's a time that we do a catch up and address what we see in front of us here.
Yeah, the headlines can be kind of scary. We're going to definitely get into that. But before we do that, Matt, how are you, man?
I'm great. I spent my weekend very similarly to you, just two different sports.
Yeah. And your sport was?
Lacrosse and soccer.
Yep. And I was in baseball all weekend. So kids sports keeping you busy, but they're out of school now, right?
They're out of school, finally. Only 7 days later than your kids.
But how are you? So what's your plan to keep them busy this summer? Like how are the Stalls keeping 4 kids that are not in school busy?
Yeah, well, this week is VBS, so Vacation Bible School for us. I don't know if you guys have the same thing.
Not this week.
It's always the first week out of school for us. And then Katie, my wife, has all sorts of summer camps planned that I'm not even quite sure I know all of them yet. So how about you guys?
You have 4 kids. Well, baseball takes us pretty deep into the summer. Yeah. And both of my boys have been lucky enough to actually make it to state already. Their teams have each won a tournament. And so that will take us into mid to late July.
Okay.
And then my oldest actually gets an opportunity to go to Cooperstown and play ball in early August. So really he's not done until the second week of August. And then, if you don't live in Minnesota, you don't understand. We don't start school till after Labor Day. So he'll have a couple of weeks.
Yeah, a couple of weeks.
We'll stay busy.
Same with soccer. It goes into mid-July.
So when we ask each other how we're doing, we're talking about our kids in sports. That's basically tells you how much that consumes. So,
which suburb did you spend your weekend?
Our lives. And part of this might just be us trying to avoid this super fun conversation of kind of talking about the economy and where the markets are. And Matt, at the end of the day, we don't want to stick our head in the sand.
Right.
And so it's like this catch-22 of we don't want to like sound alarm bells and make people think that, the sky is falling, but we also can't not acknowledge the fact that it's not exactly been a stellar year.
Right.
Economically.
Yeah. Yes.
And so to give kind of the state of the union of where we stand. Again, I don't think this is going to surprise anybody just as we record this today. And so I'm going to give kind of rough numbers. So, and the day this is recorded is definitely not the day that it's released. But as of today, Matt, headlines are all about inflation because we just set a record again. We set a record in March for the highest inflation levels in the last 40 years. And now we just broke that record here a couple of months later. I think 8.6% is the inflation number right now. We've got bond markets that are getting kind of torn apart based on rising interest rates. And on top of it, the stock market hasn't exactly fared well. The first quarter was rough. We had a bit of a bounce back, and now we're starting to feel pain again. But in the first quarter alone, Matt, the S&P had its worst start to a year since 1939. The NASDAQ, which is tech, has only been around since 1971 as an index, but it had its worst start to the year ever since 1971. And then we had a little bit of a reprieve. We kind of have this, euphoric time for a little while where the market started to bounce back. And we're like, okay, maybe it's not going to like stay sustained, and maybe we're going to kind of get some of this back. And as we stand today, the market's had a really bad week last week and a really bad start to the week this week, which puts us from an indices perspective in bear market territory. The S&P 500 is right around 23 to 24% down year to date. The Dow is less, about 18.5. The NASDAQ is really the one that's getting beat up the most. The tech sector, that's about 35% year to date. And then the Russell 2000, which is maybe less familiar to people, but that's small companies, 2,000 small companies, actually down less than the NASDAQ, which so it's down about 25% on the year. And with all of this data, Matt, comes headlines that would scare anybody. If you've got a heartbeat and you're watching this stuff and your money's invested in any of these indices or in the markets in general, I don't care if you're 35 years old and you've got 3 decades before you're going to need some of this money that you're saving, or you're 65, 70 years old and you're actually in retirement and trying to spend this money and watching it go backwards. In both cases, it's never fun, right? To watch your account balances go backwards. And frankly, it's been 12 years with any sustained pullback anyway. Yes, we've had some blips, right? We had COVID where we had a really bad month, but then it bounced back super fast. We had fourth quarter of 18 with the taper tantrum. There's been some blips, but all in all, it's been a really healthy 12 years.
Yeah.
And so for a lot of the families that we serve, Matt, they're retirees. That's kind of one of our specialties, or our specialty. And so they were working. A lot of them were still working in 08, 09 when we had this 16-month pullback of 53% in the S&P anyway. And that felt different because it was 53%, and that is a ton. I'm not trying to downplay that, but it took 16 months for that to happen. But there was, in that 16 months, there were scarier times than others.
Right.
And with last week being what it was in the markets and some of the indices down over 5% in a week, and now just today as we record this, some of these indices are down 3 to 4% in one day, on top of what happened last week and kind of more bad news on the horizon. The question, the $1 million question that I get to pose to you is, what do you do?
Nicely done. Position yourself so you got to ask that question. It is a great question. The first thing that I think you do is, those numbers we all just gave were year-to-date numbers.
Right.
And I think one of the most helpful things I've ever done, I've always liked to use Yahoo Finance. It's a simple tool that is accessible to anybody.
Yep.
And I think it's a great spot to go to get some perspective. And if you go look at the S&P 500 and you look historically over a long period of time, I think it's really helpful to do that. Number one, to educate yourself on observing the patterns that we see over time. And number two, to realize a 5-month time frame is very, very small. So we are down for the year from a number where I would argue we maybe should have never been up to, right? So
that you can make that argument.
That's step number one. Step number two.
So gain perspective.
Gain perspective. Yes, absolutely. I think we'll get to why that's helpful, because this does all come down to how do we respond and what kind of behavior do we respond with? Yep. And can we keep our heads straight throughout all this? Balancing that fear and greed. At times when things seem like they couldn't be any better, that's happened.
Yep.
We're going to see the opposite as well. So that's step number one, gain perspective. Step number two is, if we have a plan in place, then there is less reason to be concerned. And
well, to be clear on that, Matt, it's if your plan doesn't plan on things like this happening,
right? It's not a plan.
Yeah.
So that's not,
to use the word 3 times.
That's called a hope. Yeah. So it does just reinforce the planning, and listening to our podcasts or spending time in our office or spending time around any of us, you know that we like to talk about buckets, right? So we can't get away from the buckets.
Fan of buckets.
So we talk about buckets with taxes. We talk about buckets with retirement income. But that's the reason those things exist.
Yeah.
That's the reason some of the boring stuff exists is, oftentimes, sometimes we'll run to people, they want to come in and they want to talk about the flashy, exciting stuff. And it's like, let's get back to the basics. If we did proper planning in the beginning, we planned for this already. We anticipated that we're going to have rough spots.
Yep.
And, we have the buckets set up where it's now money, later money, and even later money, right? So that's step number two. Is if you don't have that plan in place, then rather than watching the market and worrying about that, you should probably ensure that that's in place and go back to the drawing board there. And then,
I think I would just add to that we, if your stomach's queasy because of what's going on, it's possible that it's simply because you don't belong in equities in the first place. You don't belong in stocks. Because if this is going to cause you to, one, lose sleep at night, or two, make decisions that long-term, short-term might feel really good, but long-term might be completely detrimental, then maybe that we shouldn't have just shouldn't have done that in the first place. Mm-hmm. The other side of that coin is maybe you do belong in equities. You just need a nice, friendly reminder that that particular portion of your plan is money that we don't need today. We don't need tomorrow. In fact, if you've been a family that we serve for any length of time, unless you've got 10 years to kind of let that bake, we don't use just a pure equity position that doesn't have some sort of, guardrail, buffer, whatever you want to call it, right, to it, so that we can kind of control some of the downside that is associated with equities from time to time. Because as much as the upside of the market is consistent, so are these blips on the way down.
Yeah. The perspective thing, I think, is super important. Understanding history, I think, is one of the most helpful things as well. And, I think we've referenced this before. When you go back in history beyond the stock market, beyond any financial market, back to the origin of looking at booms and busts, we've talked about Dutch tulip bulb, boom and bust, right?
Yep.
It's same rationale. Something's been bid up to such a high price that it's irrational, and it comes tumbling back down. Yep. And so having your head on straight, and the really, really smart people in this industry or this world know to we could look at the S&P 500 as one individual company.
Yep.
I mean, it's a collection of companies. We could look at it as one individual companies. Well, all that stuff is public information. We can look at that and know how much cash do they have on hand, what's their inventory, how many shares are outstanding, what's their earnings, all these different things. You can look at that and say, hey, it should be priced at this amount. And rarely is it ever actually priced where it's supposed to be. That pendulum swings back and forth, right?
In the short term.
And that's just something we have to expect.
Yeah. Fundamentals tend to play out in the long term. You talked about history and getting some perspective. And so there's a lot of things you could point to, but one of the things I wanted to point out today for those people that are the language that they use in our industry that are capitulating, basically the people that are like waving the white flag,
fancy language.
Yeah. They're waving the white flag. They're like, get out. I can't do it anymore. They get out of the market in times like this and they go to cash, or they do whatever they do. They just leave kind of equities. Is the Motley Fool put a study out, and there's multiple studies like this. They're not the only ones that have done this. And this data is a couple of years old, but it tells a story, and it's important to understand this. And so they looked at a period of 20 years from January 4th of 99 through December 31st of 18. So a 20-year period. And just to remind everybody, during that 20 years, we hit two really bad recessions. Mm-hmm. We had the dot-com recession, and then we also had the housing crisis in 2007, 2008, and the first part of 2009, the financial crisis, whatever you want to call it. Both of those were long or prolonged recessions with very deep drawdowns. And so, like I was saying before, like the S&P from 07 to 09 was down 53%. So we've got in this 20-year period, these two really bad recessions, right? So if you're fully invested in the S&P over that 20-year period and you just kind of let your money go, you had an annualized performance of 5.62%. Even in spite of those two massive drawdowns, if you had invested $10,000, January 4th of 1999, rode the entire .com, went back up, went all the way down during the financial crisis, 08, 09, and then come back up. And you hadn't even gotten the full-blown bull market that we've experienced. This is ending December 31st of 18, which, remind you, was not a great quarter. So actually there was a dip at the end of 18. You still would have an annualized performance of 5.62%. Now, in that 20-year period, Matt, had you missed the best 10 days in 20 years, so one day out of the market every other year on average, the best 10 days, your annualized return goes from 5.62 all the way down to 2.01, more than cut in half. If you had missed the best 20 days, so one day a year, again, not exactly one day a year, but the best 20 days, an average of one day a year, your annualized performance actually went negative to negative 0.33. To go even further, if you missed the best 60 days, on average 3 days a year during that 20-year period, out of 252 trading days, is there in a year, something like that?
Sounds right.
Okay, we'll just go with that. Yeah. If you'd have missed the best 60 days in that 20-year period in total, your total annualized performance, annualized, by the way, would have been negative 7.41%. So if you were fully invested, even through both of those markets, bear markets we talked about, that 10 grand would have turned into $29,845. Okay. If you miss the best 60 days, your 10 grand turns into $2,144.
That's crazy.
So in 20 years, if there's 365 days in a year, we both know that, right? So in 10 years, there's 3,600 and some odd days, over 7,200, 7,300 days. In 20 years, you miss less than 10% of those days in 60. Just less than actually 1%. I meant to say one. I saw one in my head and I said 10. Less than 1% of the total days and your return is negative 7.41. So history is important. Understanding, having perspective is important, and making sure that you have a plan so that when the market pulls back, not if, but when, that you don't start making irrational decisions based on the way that you feel.
Right.
And so again, one of the two things is true. Maybe you shouldn't have been in them in the first place. But if you, like, as an example, if you're a family that works with fiat, this absolutely was part of your plan. 100% of the families we work with, we do not anticipate the market's going to go up every year. We try to build a plan that's cognizant of that. And so if you're feeling that way, you may just need a friendly reminder of, hey, you've got a plan for this. This is what the plan is. And so if you're feeling that way, I would encourage you to reach out to us and give us a call, and we can talk about how we planned for this, what that looks like, and what our plan is moving forward.
Well said.
Now, times like this aren't just all doom and gloom. They also represent opportunity. So,
Absolutely.
Matt, what are some of the opportunities? Let's end on a positive note.
Yeah.
What are some of the opportunities that lie out there in a recessive type market like this?
Yeah. So big picture, some of that depends on your stage of life. Some of it does not. So that number threshold that I've always had the conversation about is we're going to pay attention when we see financial markets off 20%. That tells us that if I have some cash on the sidelines, it's time to put some of that to work.
Sure.
And we're at a point like this. And if you plan properly coming into this, you likely did have some cash on hand, whether you're a retiree or whether you're an accumulator.
Mm-hmm.
And so at this point in time, it's time to put the dry powder to work. So that's opportunity number one.
Yep. Yeah. That's a pretty simple one, right? Like, buy things when they're on sale.
Yep.
It's easy to say, it's hard to do when it comes to, it's easy to do at Target. Yep. Right. When the sweater's on sale.
Yeah.
Know how much you love sweaters.
Yep.
You know, much easier to buy the sweater at $60 than it is to buy it at $90. Much harder to buy the market at $60 instead of $90. We all want to buy it at $90. It's crazy how the psychology works, that when the market's up, we all want to buy it, even though we all know rationally that makes literally zero sense.
Right.
So now the market is, depending on the index you get in, the companies that you buy, is somewhere between, almost 20 to 35% cheaper than it was 5 to 6 months ago.
Yep.
If I just told you, if you just wait 5 to 6 months, I could get you the market on sale by about 20 to 35%. It sounds exciting.
It does.
Until you realize that also the rest of your money is sitting in there. And then you start wondering, how does this fit into my plan again? Right. That's where you call us. But if you have some dry powder, there's an opportunity. The second thing, Matt, that I would talk about is taxes. Mm-hmm. Because if you have non-retirement accounts specifically, or after-tax accounts or non-qualified accounts or whatever you want to call them, as you probably know, hopefully, that if you have this type of money, that it's kind of taxed as you go, and you have some opportunities inside of there to use losses that you've experienced this year to offset any gains that you've got baked into the portfolio, as well as just selling and taking a loss. You can actually write off losses on a non-qualified investment account at year end. And now they only let you write off up to $3,000, but it's better than nothing.
Mm-hmm.
Right. And so if you take 30 grand in losses, it's not like that other 27 that you can't write off this year just disappear. We can bank those and use those to offset future gains that we know and hope are going to come in future years if we can just stay invested.
Right. Yep. And another tax piece would be thinking about a possible Roth conversion.
Yeah. So switching to the qualified side of the equation.
Yep. Yeah. So Roth conversion, if it's something we've talked about with someone already, generally we'll wait till the end of the year. Yep. That's something that we cannot undo any longer. So that's something I've always talked about. We procrastinate on purpose a little bit there.
I always procrastinate on purpose.
But going into that concept in general,
never do it on accident.
We're taking it from a place where it's going to be taxed. And if we want to move it, we're going to pay a tax bill to somewhere where it's never going to be taxed again. So you start turning the wheels a little bit and think through this. And all right, if I'm planning to pull this out of here, it probably makes sense to do it when it's a little bit lower.
Yep.
And then if I look long term, I'm probably going to see more gain long term. And I'd rather not pay taxes on that if I could choose.
Yeah, going back to my Target example of these sweaters that you love to buy.
Yeah. I don't know this.
If you think about it from a tax perspective, we're in the middle of this Tax Cuts and Job Act. You've heard us talk about this on the podcast before. And so a lot of the families we work with, their taxes are cheaper today than we know they're going to be in 2026 when the Tax Cuts and Job Act expires. If none of that rings a bell to you, go back and listen to previous episodes of the podcast or just call the office because we talk about this all the time. But if your taxes are on sale right now, which they are for a lot of people, now all of a sudden the market's on sale. It's like going to Target, the sweater's on sale, and you have a coupon.
Mm-hmm. you wait for my eyes to light up.
The $90 sweater's on sale for $60, and you have a 20% off coupon, so you save another $12. So now all of a sudden it's $48 sweater. You're double dipping on the sale. So if we get a tax sale to go along with the market sale, to Matt's point, instead of waiting for the rebound to happen inside of your traditional IRA or your 401k, where all that growth as it comes back will remain taxable. So part of the growth you get to keep, part of it belongs to the IRS. If we convert now to Roth with some of those dollars, then the growth that comes back instead of being taxable is going to be tax-free. So there are opportunities. And then on top of that, Matt, the interest rate environment is going up. So if you're out there looking to finance your house or a car or something to that effect, that's not awesome.
Right.
But on the flip side of the coin, none of us have gotten paid anything in cash or any short-term type interest-bearing investment for years.
Right.
I mean, when you and I first teamed up at Ameriprise, do you remember? We had a cash account, fully liquid cash account, you write checks out of it, yielding 4.1%.
Yep.
Remember that?
Yep.
Now in my checking account, I get 0.02%.
Right.
So that's pretty awesome. With these interest rates coming back, there are some opportunities to take advantage of being on the investment side of interest rates and seek a little bit more yield. Again, I know some people are thinking, well, gosh, Brad, inflation's 8.6%. It's still better than nothing. Right. I'm not saying it's like, the saving grace, but it's still better than what we can get in our checking account. And so there are a few opportunities out there.
Yeah, absolutely.
We made it through it.
We did. Still in one piece. I just can't stop thinking about sweaters. Oh,
well,
man.
When the sweater's on sale and you have a coupon, you got to do something, right? Then you buy every color. I got a green one. I got a red one. That said, guys and gals, and anybody else that's listening to the podcast, maybe your dog is listening with you. Just remember that this absolutely happens. We had 12 years of a great market. We've had a pullback. I'm not even saying it's going to stay. Maybe all of a sudden it's going to rebound and we're going to be, this by the time this podcast comes out, it's just going to be a moot point. Who knows? But you have to plan for this stuff. Mm-hmm. It absolutely is going to happen. It's going to happen multiple times. Hopefully, if I live long enough to see multiple recessions, if we're just kind of playing the odds, and it needs to be part of your overall plan. The worst thing you could do is a knee-jerk reaction based on your emotions. And so if you need somebody to talk to about that and talk through your emotions, that's exactly what we're here for. Reach out to your advisor, go to our website, find your advisor on the website and get access to their calendar there and schedule time with them and utilize that relationship. I mean, if this isn't what we're for, I
don't know what it is.
I don't know what it is.
Right.
So we're here for you. Reach out to us, fiatwm.com. You can find ways of getting a hold of us, get in contact with us on the website. We will be reaching out to a lot of you as well. There's a lot of people that listen to this podcast. We've already done Roth conversions for this year, already done some tax loss harvesting and kind of putting dry powder to work. And so that said, we're trying to stay on top of this as best as we can and take advantage of all these opportunities. But we'd encourage, for those of you that aren't families of Fiat that are listening to this podcast, if you're not having these conversations with somebody or your advisor's not talking to you about these things, I'd encourage you to reach out to us as well. So as always, thank you so much for listening to Every Day is Saturday. It's hard when the market's off 20% to have an every day is Saturday type moment. But again, there are opportunities there. And so we want to make sure that everybody gets to take advantage of that. So thanks so much for listening. If you haven't done so already, subscribe to the podcast. You can do that either through our website or on whatever platform you listen to podcasts on. We would love it if you do it. Share with your friends, your family, and let them know that although the markets aren't great, It's going to be okay.
That's right.
That's right. Thanks for listening, everybody. Come back and join us in a couple of weeks for our next episode of Every Day is Saturday, and we will see you then.
Thank you for listening to Every Day is Saturday. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Fiat Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.